Hey boys, this is Trading 101. This is going to be like a 3-part course, I believe. I'm pretty sure, where I'll be diving into everything that I know and teaching you guys my strategy from trading. Now, before I do get into this and dive into the first part of the course, I want to make sure that I emphasize this to you guys, how this isn't a get rich quick kind of thing. All right, if any one of you guys think that way, you got to just change it up, because this is going to take time. All right, and I'm sure if you're already familiar with the trading realm on social media and all that, I'm not going to name any names, but you already know people who try to play this, get rich quick. Trading is a get rich quick thing, and it's just not. All right, I want to be very sincere and frank with you guys. This is why I do everything for free. I'm not going to, sell you guys anything, but I am going to make sure that I tell you this. It's not going to be easy. Nothing in life that gives you a lot of money is easy. That's the thing, all right? And this is one of those things that it's not easy. But if you give it your all, if you actually learn, if you actually take everything in from this course, you will understand how to trade and how to become profitable. Now, it might take some time. And when I mean profitable, I mean making a significant amount of money. I'm talking about hundreds of thousands, millions in trading. That will take years. Everyone who makes that amount of money now that's a trader, that took years for them, all right? However, in the way of being profitable in terms of making a lot of money, there's also consistency. You can be consistent, I guess so to say, profitable in the ways where you're making money consistently, but you're not making a shit ton of money. You know what I mean? So in reality, let's say most of you guys probably have let's just say around, I'm not saying all of you guys, but most of you guys have probably around a K balance, right? So in a K balance, trade, well within risk management. We'll get into the risk management and, in this course, but let's just say 1 to 2% of your total account, you have $1,000 account. You can be making, you're risking maybe $10, maybe $20. You can be making twice that, $20, $40 consistently. That's what I mean in terms of consistency. You can be profitable in a small way in months. You can be making money in months, all right? Becoming profitable and finally trading your own real money. But to be making a ton of money, that takes years, all right? So don't think you're going to be able to buy those Lambos that you want or that house for your parents in a couple of months. Most likely not going to happen, but you'll be able to make some money in a couple of months. That's all I can tell you guys right now. But if you guys give it your all, be patient. In a couple of years, you'll be doing exactly what you've always wanted to do in your life. Your dreams will come true. You will make a lot of money. So that's the dream I'm selling to you. All right. I'm selling to you that in a couple of years, if you actually give it your all and do what you're supposed to do, you will become profitable, very profitable. All right. So now let's get into the video right now here. So this part of the course is going to be the first thing that we're going to learn is just the basics of a couple stuff, all right? We're going to teach you the basics on this first part of the course. So, Trading 101, the first thing you got to learn is futures versus options. So, what is futures and what are options? What are you trading? At the end of the day, you don't know what you're trading, then none of this makes sense. So, you got to know first what you're trading, all right? Futures and options, those are the two things I trade. And crypto, but we'll get to that later down the line. Crypto is a whole different animal, whole different beast. But with this, you have options. We're going to do options first. Now, what I mostly do is options. I'm mostly into options. I do trade futures, but my main goal, my main baby is options, all right? So options, let me give you an example, okay? In a way, option contracts and options are, let's say you're renting an apartment with an option to buy it within a year for $200,000, all right? So you're first renting it. You're not going to buy it, but you have the option. You have the ability, the right to buy it within a year. Doesn't have to be a year, within a year for $200,000. You pay a non-refundable fee of $2,000 for this option, all right? There's a fee. Sorry, you got to pay for this fee, but this fee will allow you to buy this house that you're renting for $200,000 within a year. That is basically what a options contract means, all right? Option contract, you either got a call option, you buy, or a put option, you sell. You're buying those two options though, and you can sell those two options, but in reality, when you're day trading, you're mainly just buying those two options. You're buying a call option, you're buying a put option. All right. Now, what I want to show you guys here is now there's pros for options and there's cons for options as well. All right. So with the pros, you have higher leverage, means more money. You get more money with this. It's high leverage. All right. It's more money than investing in just stocks in general. But again, it's also a little bit more risky than just investing in stocks. All right. But it is higher leverage. So it's kind of like a win-lose scenario. You can't win everything in these kinds of trading games with options and futures. You get a lot more money trading options or futures. But when it comes to, investing in stock is probably the safer because of this. But the good thing about options is you have the ability to swing, and it's a very, very good type of investment to swing options. And by swing trade, I mean, going in from, days to weeks in a trade or months even years. There's no such thing as leaps. Those you can trade for like year expiration dates, all right? But we'll get into that later, all right? But yeah, the pros are it's higher leverage. You're making more money, and also you can swing. You can swing trade as well if you like swing trading. I day trade and I swing trade. I love swing trading options. They're very, very good forms of investment. And then you also have the cons, all right? A little bit, the cons, riskier than it is with stocks. If you know how to trade options, I wouldn't consider it that risky if you have proper risk management. But in terms of, stocks versus options or futures and options are riskier, obviously. But the other cons are it's confusing. It's a little confusing. People like to think it's very confusing. I don't think it's very confusing. If you're a smart guy, which I'm sure most of you are, right? Because you want to get into trading, you got to be somewhat smart. All right, it's not that confusing. Most people think it's confusing because of the Greeks. They look at the Greeks, like delta, theta, gamma, all of that, vega. They look at that and they think, oh man, it's too confusing. All these numbers. It's not that confusing once you actually get into the swing of things and understand what's important with those Greeks, what you need to know about those Greeks. Very simple, and I'll be teaching you guys exactly what you need to know about these Greeks, and you'll see how simple it is. All right. There's no pattern. There is a pattern day trading rule. And in a way, if you're day trading, you can't day trade, more times. So you can't keep trading in a certain amount of day if you surpass a certain limit. So there is that kind of thing as well. And it's only 9 to 4. So, from 9 to 4, you can only trade then, when the market actually opens. You can't, it's not like futures, it's not like any other like stuff like that. You have to wait for the market to open like 9:30 and then it closes at 4. So there is that kind of thing too, but that doesn't matter to me. When I day trade options, I get up, it's at 9:30 for me, Eastern time. So I get up 9:30, I do my charts, get in a trade, and by 11, I'm done. So it's really not that bad. The spreads, sometimes this isn't that bad of a thing. All these cons that you're looking at can be completely overridden if you're doing it right. But there is whack-ass spreads. I got to say, there is whack-ass spreads. But that's why you only trade those stocks that you know of, like Apple, Google, SPY, QQQ. You only trade those options, and the spreads are tight because you want it tight, all right? You like it tight. You want the spreads to be tight because if there's whack-ass spreads where they're too, wide of a range, and you understand what I mean by that once we get into that, the more important part of the course. But, spreads, those are the cons of options, if you're trading wrongly. But if you know how to get the right kind of spreads, it's not a problem. And I'll be teaching you guys how to get the right kind of everything, But they're also more volatile. I don't know if you consider that a pro or a con, but, if you don't know how to trade and you're not trading correctly, then more volatile is probably a con. But, yeah, those are the cons for options, and they're not that bad, in my opinion. If you know what you're doing, they're not that bad. Good pros, though. You can swing trade options. I love swing trading options, and I'll be, making a course on swing trading so you guys understand how I do my stuff. Sorry, that's my dog. But then there is higher leverage, but also there's higher leverage with futures too, so we're getting into futures. Now, with futures, an example of futures. Let's say you're pre-ordering a new smartphone that will be released in 6 months. So you and the retailer agree that you pay $1,000 for the phone when it is released, all right? but you're pre-ordering. So this pre-order agreement is similar to a futures contract. All right, you're pre-ordering a new smartphone that's going to be released in 6 months, and you are paying the 1,000 for the phone when it is released. That's kind of like a futures contract. All right, no pattern day trading rule. You can trade however many times you want. No Greeks. 23 hours a day, 6 days a week, and there's no crazy spreads like options. All right. So if you're just starting out, I don't like to tell people, to just do futures. I like to ask people like to at least try everything. I'm not really a Forex kind of man. I don't trade Forex, but I have tried, all right? I've tried trading like everything, all right? And that's what I kind of recommend everyone else to do. Trade everything and just see which one you like best. All right, that's my kind of opinion to you. I'm not going to tell you to trade futures if you're a beginner because you might like options. You might like Forex. I don't fucking trade Forex. I don't like it, but you might like it. And, this strategy will work for all of that. All right, so trade what you want to trade. Just try all of them. Dip your feet into all of them just to see which one you like best. But yeah, no crazy spreads. Those are the pros for futures, but they do have less leverage than options, but they still have high leverage. So it's a con. It's not really a con. It's a con in terms of, futures versus options. Yeah, but they're still pretty high leverage. All right. But higher margin requirements. You need more money to be put into futures. If you're trading your own account, when you're day trading futures, you need more money to put into that. But it's kind of the same thing with options. If you're trying to get to an options broker, if you do a margin account, where you're putting some money up front, but they're wielding most of the money for you, you only have to put in, I think Schwab does 2,500 for a margin account. That's all you need to put in. And with futures, a little bit different, but you can get prop firms, which is a great thing for futures. Options, I don't know if options have prop firms. I'm not really familiar with that because I don't do prop firms, but I know futures has a lot of prop firms like Apex and Top Step. You can get into that, and you only have to pay $50, 25 monthly, something like that, some shit like that, and make money. Though it is harder to make money in prop firms for futures. I don't know if you guys know what prop firms are, how they're used. They make it very difficult for you guys to actually get the money, but you don't have to put that much money in. All right, you pay a couple $50 monthly. You get an account, prop firm account, a funded account, which you can trade for that. All right, but yeah, now we got the indexes here. All right, so on the index here, you're looking at SPY, which is Fortune 500 of the New York Stock Exchange, and ES is the futures version of that. So when you're looking at SPY, the index to trade on options, it's SPY, but ES, that's the ticker symbol. ES is the futures version. So if you're day trading futures, ES. If you're day trading options, SPY. Same thing goes for QQQ. QQQ is the 100 largest companies on NASDAQ. And if you're trading, options, QQQ. But if you're trading, the futures version of it, NQ. That's it, basically. But yeah, the NYSE just means the New York Stock Exchange, and NASDAQ just means the National Association of Security Dealers and Automated Quotations. You guys don't need to fucking know that. Just NASDAQ for short, and New York Stock Exchange, whatever. But yeah, that's basically it. And then you got the brokers here. So the first one's the brokers. You got Schwab. They do both, options and futures on Schwab, on Thinkorswim, their platforms. If you want to get into that as well. But, when it comes to futures, I'm sure most of you guys, if you guys do trade futures, you guys are going to want to get a prop firm for futures. But, if you do want to get into Schwab and trade futures, do so. But it's a high margin requirement on Schwab, so just saying here. But yeah, Schwab is what I use to trade options. Very good. Margin requirement of $2K, 2,500 to get into a margin account, which is what I recommend you guys get into. Tasty Trade and other options. Webull, another one. Robinhood. I don't like Robinhood too much for trading options. I think their setup is very weird and difficult. Schwab's Thinkorswim's platform it's complex, but they have a lot of things that can help you. They have a lot of systems in their platform that will help you become a better trader. Robinhood is just weird. It's difficult to travel through their platform and their system, which is why I don't recommend you guys to Robinhood. Tasty Trade, Schwab, and Webull are perfectly good for options if you're trying to get into that. They do have high margin requirements, mostly for trading futures. For options, get a margin account. It's not that expensive. Higher fees, not really, only for trading, futures. It's free. You can get it for free. You can get into the broker and get the platform for free. But you can't put in real money to trade unless you actually, get that margin account in there, right? And you can also trade options. All right. So with options, I recommend you guys probably go for Schwab, tastytrade, or Webull. Those are my recommendations for you guys. Now with futures, these are the brokers. All right. You got NinjaTrader, very good brokerage. Tradeovate, Quantower, and TradeStation. Basically, very good futures brokerage. Low margin requirements, low fees they have. It is subscription based. You do have to pay subscription, but they don't have any options, and it can though be linked to prop firms. So if you want to trade futures, go for the prop firms basically. And in my opinion, I'm guessing most of you guys, like I said, I don't want to sound like a broken record here, but most of you guys are going to want to trade prop firms, and I recommend you guys trade prop firms first if you're not really, advanced. I would say, you're just a beginner. I would recommend you trade prop firms if you're trading futures first. All right. But the prop firms here, the most popular ones are Apex and Top Step. All right. They're basically kind of the same thing, but, with Apex, it is easy to pass. They're kind of like the reverse. So they are the reverse. They're easy to pass, very good to pass the evaluation. And because obviously all the prop firms have an evaluation phase. So you have to get a certain amount first to actually get to the point where you can trade to get payouts. So you have to pass the evaluation first, right? And with Apex, it's easy to pass the evaluation, but it's difficult for payouts. So with Top Step, just the reverse. It's harder to pass the evaluation, but it is easier to get paid out. So whichever one you fancy best. They're basically the same thing though. If you're a good trader, if you're a good trader, you're profitable, you can pass any of these accounts, all right? Now, with option contracts. So when selecting an option contract, and this is for the option traders here, most of this video is going to be based off like options, I would say, because that's what I trade mostly. But the strategy can be intertwined into every single form of trading. So if you're trading futures, if you're trading options or Forex, crypto, fuck it, any of that kind of thing, you can use my strategy for all of that, right? But looking at the option contract first, we're going to tell you guys how to get into the option contract. This is like the last kind of thing I'm going to be teaching you guys. Traversing into where we're going to go for the next part of the course. This is kind of like just the start of it. Dip your feet a little bit if you are trading options, and showing you guys how I'm looking at option contracts and how to look at the option chain to get in day trades on options, all right? But with the option contract, you want to select I can't stress you this enough. This is everything. If you're day trading options, this is what you want to see to actually get into that option contract, all right? So this is very important, which is why I didn't put this in the next part of the course. I'm putting this in this part of the course so you guys understand how crucial it is, okay? So when selecting an option contract, you want it to be high delta. And I'll show you guys the option chain in the next slide so you understand what I mean by all this. But you want there to be high delta. Now, what I mean by high delta is you want to see delta of 0.30 or more. Usually more than 0.30. I'd like to go for like 0.40, but 0.30 or more, all right? And how much the contract will go up or down per dollar move of the underlying asset. That's what the delta basically means. You don't have to know these definitions. You just have to know exactly how to look at these in the option chain and find the right contract, all right? Which is why people make this so confusing. They look at the Greeks and they think, man, this seems too difficult, man. I don't know what the hell this means. Like how much the contract will go up or down per dollar move of underlying asset. How does that affect what I'm doing? It really doesn't. Just forget the definition. Most people don't tell you this, but just forget the definition. Just first listen to me and understand this is a delta. That's what it means, all right? You don't have to know what that means. You have to know how to find the correct amount, a number of delta in an option chain. And I'm telling you guys what it is right now, 0.30 or more. It's basically the higher probability of that stock moving in the money. What that means, again, is basically there's a higher probability of you making money if your trade goes the right way. All right, that's basically what that means. That's why you want high delta. I hope that made sense, all right? But let's say, for example, if SPY is worth $300 and you buy a contract worth 0.50 with a delta of 0.30. If SPY moves up $1, the contract is now worth 0.80 because it was worth 0.50, but a delta of 0.30 means if it goes up $1, you add 0.30 to 0.50, 0.80. Simple, right? So that's basically that. You want to have high delta in that contract you're looking at. Volume, you want it to be a high volume, all right? When we're looking at volume, it's the number of contracts that are being bought or sold. You obviously want to have high volume for that. You don't want to trade with nothing. So it's kind of common sense when you're looking at volume and open interest. It's like you want there to be high volume and open interest because you want people to be in that trade with you. You understand what I mean? So volume has to be really high. Open interest has to be really high too. That's the number of open buy and sell orders, all right, that are open in the trade. You want those two to be high, simple enough, and I'll show you exactly how this looks in the option chain and everything like that. But as well, we want to look at implied volatility of 70% or more. That's how volatile the contract can be. Implied volatility means not as much as delta, volume, and open interest. What I really look for is these three. But implied volatility, you mainly want to see something with 70% or more. Not all the time, not as important. Implied volatility is probably the least important of looking at an option contract rather than these four. But with implied volatility, you want to see how volatile the contract can be. You want it to be volatile. You want there to be a move, all right? In one direction or another, you want there to be a move. You don't just want it to be not volatile and it's just moving sideways, that contract, all right? Because if the contract's moving sideways, the contract isn't that volatile, whatever move the stock makes, let's say you're in an option contract for SPY, whatever move the stock makes on SPY, but the contract isn't volatile, the contract is consolidating, but the stock can move up. You buy calls because you predict the SPY to go up. The contract that you chose has very low implied volatility. It's just consolidating. Even if the stock goes up, your call option is consolidating. You're not making any money. You understand what I mean? Simple as that. So make sure that implied volatility is somewhat high, all right? And then, based on if you're day trading options, if you choose like the blue chip stocks, like, Apple, Tesla, all of that, or SPY and QQQ, most of their contracts are going to be volatile. So that's not a problem. That's why it's the least important, all right? And then last one is the spread. So the spread, again, we like it tight. We want it to be tight. You want the spread to be tight. And that's the difference between the bid and the ask. So the bid is how much the contract is worth to sell, and ask is how much the contract is worth to buy. So how much you're going to sell is the bid. And if you're trying to sell the contract, that's the bid. If you're trying to buy the contract, that's the ask price. All right, it's basically that. And you want the difference between the bid and the ask to be tight. And we'll show you what I mean again on the option chain. And unlike futures, option spreads can vary. If you're trading some unknown option or stock, and you're using their option contract, their spreads can be very, very wide. So that's why I only focus on the blue chip stocks, the ones with a lot of volume, the ones that are well known, like SPY, QQQ, Tesla, Google, Apple, Nvidia, AMD, Meta, all of that, just for that reason, all right? Because we want the spreads to be tight. We want a tight spread, all right? And showing you guys exactly what I mean on the option chain, all right? I'm gonna take a sip of water here if you don't mind. Now, the option chain, I understand this looks complex as fuck to you when you're just looking at this right now, but trust me, it'll make sense once I explain this to you, all right? All you're looking at, let's say we're looking at the stock of SPY, okay? If I'm getting in a day trade, I took a screenshot of this thing. Was it today? I think this was today. I took a screenshot of this. I don't know what day it is right now, but I took a screenshot of this, and just to show you guys, this is a 0DT, so this is 0 dates till expiration, okay? So in a day trade, you're usually going to get in an option contract with a 0 date till expiration, or you're going to get an option contract with a 1 day or maybe a week. For SPY and QQQ, they have 0 DTE, 0 days till expiration every day. But for, Meta, all those other blue chip stocks like Meta, Google, Apple, all of that, they have days till expiration for a week. So let's say it's Monday, and you're trying to trade like Tesla, and it's Monday. That contract, the first contract you're going to see of the expiration is going to be a week out. So that's basically what I'm trying to tell you. But SPY QQQ, each day has its own expiration date. All right. So if you're trading on a Monday, there's going to be an expiration date for Monday on SPY and QQQ. But if you're trading like Tesla, Google, all of that, It's not going to be day by day expiration. It's going to be a weekly expiration. Okay. And let's go into exactly what I'm looking for if I'm day trading. All right. I want a 0 days till expiration here. And the first thing I'm looking at, and as you can see here, I really don't have implied volatility in my setup when I'm looking at my layout here. If you can see my layout, you just click on here and you can put whatever you need. This is the stuff you should have. So click on your layout. If you are trading options, or day trading options, click on your layout and just put open interest, volume, delta, theta, net change, and last X. All right. But the ones you're really looking at is open interest, volume, delta, and theta. Just put those on there, and that's really all you need. Sometimes I do look at implied volatility, but not on here. But if you want to go ahead and put it on there for you, you can. This is just my setup. But if you want to put some other stuff in there, go by all means. If you just want to put these 4, perfect. And if you want to add implied volatility on that, go ahead. I don't. But yeah, so let's say we're looking at to get into a trade here, right? Let's say we're going on the call side. As you can see, they have a call side here. And first, let me just go over exactly what the option chain is looking like, right? So you're on SPY. That's the stock right here. That's the ticker symbol you put SPY. And then you're looking at this, all right? The only important thing you got to see here is how much volume this actual stock is trading, 25 million. That's very high. Good. Stock's trading very high. That's the good thing to see. And then you go into the option chain. When you look at the option chain, you have a call side and a put side. If you're buying an option contract, a call option contract, that's because you expect the price to go up. You expect the price of SPY to go up. So let's say it's at 528, you expect it to go above 528 to like 529, something like that, some number above this. Or you're getting a put contract. You expect the price to go down, the price of SPY to go down. So that's why you would get into and buy a put contract. So you're buying 2 contracts, but with put, you're expecting the price to go down, and with calls, you're expecting the price to go up. That's basically it, okay? So a lot of people is confused. They think they sell puts. No, you're buying both of these contracts. But the puts just means that, oh, I think the price is going to go down of the underlying stock that I'm buying. So I want to get into an option contract for SPY, but a put one because I believe SPY is going to go from 528 to 527, whatever. But calls, I believe SPY is going to go from trading at 528 to 529. So I'm going to get into an call option contract so I can make money from SPY going up. Basically what that means. That's it. Making it very simple for you guys so you guys understand and you guys don't have to, like fucking just overheat your brain from trying to learn all this, okay? But once we're getting into this, how I look at it to get into a trader, right? You have the bid and the ask. The ask, again, means the price that you're willing to buy the contract for. And bid is the one you're willing to sell. So if you're day trading, buy. Ask. Don't click on the bid, all right? Most of the time, you're never going to use the bid. You just want to look at it to see if the spreads are tight. Again, spreads tight. Bid, ask. Look at this. Look at these spreads. 2 cent difference, man. 2 cent difference on this contract, bro. 1 cent. 1. This is a tight spread. This is what we want. You're looking at these. You got to look at a contract with tight spreads. Look, 185, 186. That's what we want. We don't want some shit that says $1 to like $3, which is what you're going to find if you trade options that no one knows of. This is why you want to trade the well-known stocks. But that's all you got to see. So you got to see if it's tight spread, very tight spread. This is what we like, all right? This is what we like. You don't want to fucking see one like, I wouldn't even consider this wide, but it's wider than we want, which is why no one buys all the way up here, We want to buy out of the money. The blue means it's in the money. Out means out of the money. And when you're buying contracts that are out of the money, which is this black part here, that means once the contract goes in the money, goes into this blue thing, you're going to make a lot more money based on the volatility of it all. It sounds so complex. You guys don't need to know how. I'm not teaching you guys this so you understand exactly why that makes sense. I'm just teaching you guys so you guys understand that that's how it works, all right? The reason why you buy contracts out of the money for it to go in the money is because you make more money because it's out of the money and then it's going into the money than you would make if it's already in the money and it just goes above more spots in the money, all right? But yeah, so you're going to look at the spreads, make sure it's tight. This is very tight. So let's say we're in a call. We want to buy a call contract because we believe SPY is going to go up. I'm looking at this, all right? Now I'm looking at, let's see, delta right here. Open interest volume. Let's go one by one, all right? So we don't really want one that's going in the money. So we're going to look at out of the money here, right? Now, look here. Open interest. This is what I mean. Thousands. Volume. Thousands. I don't want you to fucking get into these contracts, bro. Look at this. 28, 7. No one's in this. No one's going in this. No one's trading here, bro. Don't trade here. No one's going to do that. Just literally, you see there, we want in the thousands for open interest and volume. That's all I'm going to say. We want in the thousands. That means there's a lot of interest. There's a lot of participants in this option contract. That means you can get filled easier. Obviously, when you get into you obviously have to buy an option contract. You want to get filled. Now you can either buy a market at a market price, which is what you do when you click here. You buy at market price. You get filled instantly, only if the open interest and volume is high. Obviously, that's why I'm telling you guys, because newbies like to get in at market price. They don't want to get filled at the limit price, which is basically what you do is you click on an option contract and you want to get it filled at a limit, which means once this ask price goes down a certain level to the one you want, you'll get filled and you'll be in that trade. Market price is whatever the option contract is trading at that moment. And with tight spreads and well-known stocks like SPY, market price is perfectly fine. You can get into that market price, which is why we trade these well-known stocks, because then you guys can get into the market price. But yeah, we want a lot of open interest and a lot of volume. And as you already know, I'm looking for ones that are very close out of the money that could potentially get in the money. So we're looking at like these two basically. Let's say these two, we have very high open interest and very high volume in both of these. But I'm inching more towards this one right here because it has more. That's what we want. We want more. And they're both valid still, but let's look at something else here, all right? Now we have delta. Again, 0.30 or more. This one has a delta of 0.43. This one has a delta of 0.34. Both good. The strike price of 529 is the better one in terms of delta. And when I say looking at strike price, this is the strike price right here of the option contract. This is not the price of SPY. SPY is 528 right now. And basically what that means is the strike price, however much the option contract is, it'll be in the money. So if this is 528 and you get into a contract, let's say you have this contract at 528, it's in the money already because SPY is already above 528. So this right here is not in the money, right? It's out of the money at 529. But once SPY gets to 529, this contract will then be in the money. You understand what I mean? This is why you want to buy one that's very close to the stock of SPY, but not already there, all right? That's what we're trying to do, guys, for you, okay? So I'm looking at 529, and I like 529 more. Now, obviously, 530 has more open interest, has more volume, but SPY at 529 has enough. It has enough, all right? We want in the thousands, and 529 strike price did just that. It got in the thousands, and it has high delta. We want more delta involved. And although 0.34 is very good, very nice, 0.43 to me is a little better. But mostly the reason why any of these two are valid, in my opinion, is because they have everything good. High volume, high open interest, high delta. Their theta isn't that bad. In terms of theta, when you're day trading, you're going to get high theta in these 0 DTE, 0 days till expiration, 1 DTE, weekly expiration. You're going to get higher theta than you would if you went out like a month out in expiration, right? So let's say you were trading September, October, December, you'd have lower theta because you're basically swing trading that, and lower theta is good. But with day trading options, theta isn't as important, all right? But obviously don't stick to that trade. If you're trading CRDTE, don't stay in that trade for very long. You're expecting this trade to be like a scalp trade or a very short intraday trade that won't be longer than like hours, all right? So that's basically what it means when you're day trading options. Don't look at theta as that important, but only because you won't be in that trade for that long. Now, when we're getting into is we're looking exactly as to why both of these are valid, all right? 529, 530. Lucas, why are both of these valid? You say you get into one, but why can you get into the other one? Basically means as how much money do you guys have to put in a trade, or how much money is good for your risk management? If I'm able to put $147, I'm going to go with 529. But some people might not be able to do that, and they're going to put $100 in. Go for $100 because these two are still very valid. You'd obviously make more money if the underlying value of SPY went up, if you chose the 529 option contract, but you still make money with the 531. So it's kind of a give and take, whichever one's better for you at the end of the day. All right. If 529 is good for you, you can put $147 in, or you can fill a limit price to whatever price you want to get filled at. By all means, get filled at the 529 option contract. But if you can't, if you want to go to 530, put less money into it, go for the 530 option contract. So both of these are valid because they all have the same kind of same setup. They had the same good setup. Like I said, we went back here. High delta, high volume, high open interest. Spread is tight, right? Implied volatility. When I'm looking at these stocks like SPY, this is why I really don't put implied volatility, because all of these have high implied volatility, all right? All of these. But the most important thing is high delta. Did both of these have high delta? Yes. Do both of these have high open interest? Yes. High volume? Yes. That's basically it. That's all you gotta do. So whichever one you want to choose is just based up totally onto you, all right? But yeah, I would choose the 529, and I'd get in for a limit price either of 145 maybe if I wanted to fill a limit price. I get in at limit prices, but with these type of contracts, like I say, I'm gonna keep repeating myself in this entire video. With these stocks, you can go in for market price and get filled in at whatever the market price is at, all right? But yeah, that is basically everything for this part of the course. This is Trading 101 Part 1. Trading 101 Part 2 will be diving into the actual look of the market and the strategies and all of that, all right? But yeah, I will see you for the next part.